Gold, silver, and other precious metals have rallied sharply over the past 2 years, capturing a lot of investor attention. Gold recently climbed above $4,700 per ounce, while silver moved past $90, historic milestones for both metals. With prices at these levels, it's natural for investors to ask an important question: should I be investing in precious metals right now? As with any investment, it helps to step back and look at the bigger picture, how these assets behave over time, and how they fit into a well-constructed portfolio. Precious metals are often described as safe haven investments, but like other commodities, they're prone to boom and bust cycles. Today's rallies in gold and silver aren't happening in isolation. They're occurring alongside strength in many other asset classes, driven by uncertainty around monetary policy, fiscal policy, and geopolitical risk. That's why precious metals are best viewed not as speculative trades, but as strategic components of a diversified investment plan aligned with your long-term goals. So what's driving the surge? One major factor has been heightened uncertainty around monetary policy, particularly recent tensions between the White House and the Federal Reserve. With questions surrounding central bank independence and the future direction of policy, especially as Fed Chair Jerome Powell's term ends in May of 2026, some investors are positioning for lower rates or higher inflation. Both tend to pressure the dollar, which increases the appeal of assets seen as store of value. At the same time, central banks around the world have been consistent buyers of gold. As they diversify away from dollar-denominated reserves, gold has played a growing role in maintaining currency stability, especially amid geopolitical uncertainty. Gold and silver have also benefited from their industrial uses, from electric vehicles and solar panels to artificial intelligence hardware. Both metals sit at the intersection of precious assets and industrial commodities. History gives us useful perspective here. Periods of monetary uncertainty have often coincided with strong precious metals performance. In the 1970s, gold and silver surged during stagflation. They rose again during the global financial crisis from 2008 to 2011, and once more during the 2020 pandemic. But in each case, prices reversed once economic conditions stabilized. That creates two challenges for investors chasing recent performance. First, forecasting gold and silver prices means predicting interest rates, inflation, and global trade dynamics, factors that are notoriously difficult to forecast. Even widespread inflation fears in 2021 and 2022 didn't play out as many expected. Second, precious metal rallies are extremely hard to time. Gold's peak in 1980 wasn't reached again for nearly 3 decades. Silver has experienced similar long stretches of underperformance between rallies, despite strong demand stories. Other metals, like palladium, have followed the same pattern: sharp gains followed by steep declines. So how should investors think about precious metals? When they make sense in a portfolio, gold and silver are best viewed as part of a broader commodities or alternatives allocation. For example, the Bloomberg Commodity Index allocates less than 20% combined to gold and silver, alongside energy, industrial metals, and agriculture. This diversification helps manage the volatility of any single commodity. Precious metals can add value because they behave differently than stocks and bonds, but they also have limitations. They produce no income, are difficult to value, and can distract from long-term growth and income potential of equities and fixed income if overweighted. The key takeaway is simple. While gold and silver have performed well recently, they're just one piece of a much larger puzzle. Long-term investors should judge precious metals not by recent headlines, but by how they contribute to balance and resilience across different market environments.